Welcome, everyone. Thank you for joining us. Without further ado, it is my pleasure to introduce Lyn Alden, analyst at Elliott Wave Trader. To our live viewers, please type in any questions for Lyn in the chat box, and time permitting, we will announce questions at the end of this presentation. With that said, I'll be right here. If you need anything, the floor is all yours.
Hello, everyone, and thank you for coming. I'm going to keep the presentation on the shorter side to try to make room for questions because I think these really benefit from being interactive. This topic is going to be focusing on the fiscal dominance that the economy is currently in, the United States economy, and what investing implications that might have. And the reason I emphasize this topic so much lately is that it's different than almost any other environment over the past 40 years or so. So basically, any of our investing careers, anyone really actively investing and trading today has not really seen this type of environment before. Even going back to the 70s, you have to go back very far to find similar periods of fiscal dominance in the United States. And the closest modern analogs we have is what has happened in emerging markets, and then to some extent Japan, which is a pretty different story. So I'm going to walk through a handful of charts to kind of explain the topic of fiscal dominance, demonstrate what that means, go over some investments around it, and then take some questions. So when we start out, this is just a chart from the Congressional Budget Office that projects what the deficits are going to be like as a percentage of GDP. And as you can see, during recessions, you get these big spikes, especially these two very big, unusual ones. But even outside of that, we're just in a structurally rising deficits now. Even before the COVID spike, for example, deficits started to increase again, right? So we had an economic expansion, but we had rising deficits. And going forward, these are very large percentage of GDP deficits. And if anything, this chart kind of understates it because they assume no recessions in this entire period. So they're like, okay, we're not going to have any more spikes. It's just no recessions ever, and these are our deficits anyway. And two, percentage of GDP can kind of mask the size because very large deficits are a type of stimulus in a sense, a type of inflationary stimulus. And they contribute to nominal GDP going up faster, at least in those units measured, nominal units. And so it becomes a recursive measurement. Deficits feed into nominal GDP, which actually kind of keeps the percentage of GDP of deficits in check, even though if you compare deficits to like the prior year's GDP or the GDP from 2 years ago, those deficits would be very big. And so this is now structurally a backdrop that was not present for most of our investing time horizon. We get these brief bursts of high deficits, usually during recessions, and otherwise we'd have fairly low deficits. And now, recession aside, we just have structurally higher deficits, and this does have investing implications. There's a couple ways we can kind of further measure that than just the simple deficit as a percentage of GDP measurement. The first one I'll go through here is annual deficits compared to private sector credit creation. And there are two main ways that the private sector creates debt. There's some other ones, but there's two really big ones. One of them is bank loans, how much new bank lending is happening. When we go back to the 70s, for example, that was the peak period of bank lending driven money creation. And the other one is basically corporate bond issuance. Various entities can issue securities, raise debt, and use that as financing. There are also private lending and things like that, but those are still a fairly small percentage of the market. And when we look over the longer term, these two charts together, this one's, the 1955 to 1990, and this one's 1990 to the present. So together, there are almost 70 years. And what they do is they compare the red line is the annual fiscal deficit in dollar amounts. And the blue line is the sum of bank loans, like new bank loans made that year, net new bank loans, and net new corporate bond issuance. Again, in just dollar terms, just raw size. And what we saw historically, both for this whole period and then even going up for most of this period, you would generally have that the private sector credit creation is bigger than the annual fiscal deficits. And the brief exceptions were generally right after recessions. You'd have these kind of bursts of, higher deficits, lower kind of a credit contraction combined with a higher deficit. You get these brief yellow areas of reversed. But ever since the global financial crisis, I mean, this was obviously a very big one, where we had massively declined credit creation and massively increased deficits. But what makes this more recent period unique is that we have deficits exceeding the sum of private sector bank credit creation, uh, despite not having a recession, right? So that's new. We have to go back to actually the kind of the Vietnam War to see even brief instances of that. Um, and this was occurring all pre-COVID, right? So in 2018, 2019, we started to see deficits exceed the private sector. And then, we briefly touched here in 2022, but then in 2023 and lately, again, we have deficits bigger than private sector bank lending. So a lot of traditional analysis focuses on the credit cycle, basically the blue line, right? This credit cycle that happens. But now when we have this red line that in many cases is bigger, that becomes a much more important variable to consider in our investments. Another way to quantify this is to compare deficits to the unemployment rate. Um, and historically, they've been quite correlated. Generally speaking, you get rising unemployment and bigger deficits in a recession, and that's partially because fewer people employed, fewer people are paying taxes. There's more unemployment benefits going out, things like that. And then in addition, sometimes the government will do stimulus, so they'll add to the deficit in an effort to kind of pull that around. And historically, they're very correlated. And there's some very brief exceptions. So Vietnam War was one of them. You had an increase in the deficit despite falling unemployment. It's a little blip on the radar. But other than that period, there's really not any sort of breaking of the correlation again until the same period, right? So all this kind of multi-year period pre-COVID, you had falling unemployment to historically pretty low levels, and yet the deficit, which was shrinking after the craziness of 2008, started to go back up. And this is percentage of GDP terms, so the raw would be bigger. But so you started to get a rising deficit despite falling unemployment. And then we had the whole go through COVID, and then again we have this low but rising unemployment, but we still have very high deficits as a percentage of GDP. So we've had a very significant decoupling. And again, this is not really like anything in any of the audience's like active career of investing, the past kind of 40, 50 years. Um, and so this is like a new environment that we have to navigate, because the question is, well, what is this going to do next time we have a recession if it's already this high? These are just background considerations. Um, and one thing I wanted to focus on was how this impacts recessions. Because right now, one of the biggest topics in finance is, are we going to enter a recession or not? And I kind of think that's actually the wrong question. I've been emphasizing that in this period of unusually high fiscal deficits and unusually high interest rates, at least for the modern, very indebted economy that we find ourselves in, you have a lot of dislocation between sectors. If you're a sector that is not really on the receiving side of those deficits, um, and yet you are very leveraged, let's say commercial real estate, for example, then you've been in a world of hurt for the past few years. On the other hand, if you're not as leveraged, and if you or your customers are on the receiving side of those deficits, you're in pretty good shape. And so, for example, a lot of the deficits, Medicare, Medicaid, Social Security, and interest expense is paid out toward generally wealthier and older individuals. And so healthcare companies have been doing pretty well, as well as travel and leisure companies, especially in the post-COVID environment where they benefited from that kind of like period where people couldn't travel, and then they do catch up on travel. And so they're not very leveraged areas, and there's a lot of just government deficits flowing directly or indirectly toward those areas. And so you get really big dislocations between different sectors. Um, and one of the things I point out is that 2002, in many ways, had recession indicators, even though it was not a National Bureau of Economic Research defined recession, which is generally how it's officially done. And so, for example, this blue line is consumer sentiment. So the University of Michigan National Consumer Sentiment Survey, it's been going on for decades, and it reached effectively record lows in 2022. And it's since rebounded, but it's still on the lower end of average. It's below average. And the red line is the misery index, which is an old economic indicator that is simply the sum of the unemployment rate and CPI, consumer price inflation. And we saw, obviously there's misery during the lockdowns. I mean, that's a unique experience. Then everybody got stimulus checks, everything kind of normalized. But then we saw again in 2022, as inflation was raging at its peak, the misery index reached recession levels. I mean, it reached levels that you roughly got to at the global financial crisis and got to you didn't even get to in this recession. You got to back in the early 90s recession and even higher back then. So that the reason it's called a misery index is because people can be impacted in different ways. In a traditional disinflationary recession, uh, generally the people that are impacted are the small percentage of people that are laid off. They're heavily impacted, and everyone else is either unimpacted or is just a little bit tense about maybe losing their job or maybe asking for, a little bit less of a raise than they might otherwise push for. So, sentiment's down a little bit, but 90 some percent of people aren't tangibly affected. Whereas in an inflationary recession, even people that have jobs can still be impacted if their income is not keeping up with inflation, let alone like really real measured inflation. CPI is a complicated measurement that has all sorts of shortcomings to it. One of the simple things you compare it to is just effectively, can you buy a house or not? Like what is the multiple of house prices to incomes, or what is the affordability index when you include mortgage rates and things like that? And that's through the roof during this period. Um, and so basically, it's impacting more people because recessions can take different forms. If you look at emerging markets, which are generally more inflationary, when they go through recessions, it doesn't really look usually like we see in developed countries. Usually, we see more of a currency crisis type of recession. They have external debts that have issues. Their currency often gets heavily diluted because they're running these very large deficit operations. And sometimes instead of high unemployment, you just get the fact that everyone's paycheck basically lost, 10, 20, 30% of purchasing power in a short period of time. So everybody's suffering. Everybody can buy fewer essentials and buy fewer imports, and everybody's squeezing their belts, even though it's not necessarily showing up specifically in unemployment. And I think that basically when a developed market goes through an inflationary period, and especially when it's in fiscal dominance, our recessions start to look more like emerging markets. And so everybody's asking, are we going to have a recession next year? And I think not enough people are saying, did we actually kind of have one in 2022? It's just that they look different when we have these, again, going back to these very unique environments, and recessions can look different in those environments. Another way of looking at this is the senior loan officer surveys. It's a pretty widely watched survey. There's a bunch of different types. This is kind of the most common one. It's the percentage of banks that are tightening standards for business loans. And you can also look at ones for consumer loans, but the business ones tend to be the most cyclical. And what you generally see is that, in the conditions leading up to a recession, usually they're tightening. So a lot of banks, when they're asked, they're saying, yes, we're tightening our lending standards. We're trying to make less risky loans. We're scrutinizing our potential loan applicants more. And as the recession subsides, you see it's still tightening, but it's tightening at a lower rate. And eventually you get into more banks are saying, no, we're loosening standards now. Things are great, right? So this is a pretty solid recession correlation. You get a little brief spike here that was not a recession. There's a lot of things that kind of show up in that period. That was long-term capital management blowing up, and you had the Fed easing a little bit. So yeah, like a little blip here. But other than that, anytime you get a pretty meaningful spike, especially when you go up to more than 40% of banks saying that they're tightening lending, you get a recession, or you're already in one. This one happened so fast that it kind of came later, but it's still effectively the same thing. And again, we see in 2022, by all accounts, I mean by this particular indicator, we had a recession. We had a recession in credit availability for businesses. Um, and but in a different environment, if we were running 2% of GDP deficits, this could very well have been a just full-on recession because you had a credit contraction and there'd be fewer offsets. But when you're running 7% of GDP deficits, you're kind of pre-stimulating before you even have a recession. There's on one hand, money's tightening, But on the other hand, that's a smaller tightening force than what you get from the deficits. And it doesn't go to the same people. It doesn't necessarily have the same velocity, but it is impacting the economy. Um, and so those are some of the things I'm focusing on when I talk about the idea of fiscal dominance and how it can shape our general like average expectations of how economic cycles play out. We don't necessarily want to fight the same battle that we fought for the past 10, 20, 30, 40 years, depending on how long we've been investing. Um, the last slide here is just kind of showing current, rate expectations. Obviously, the market is heavily pricing in the expectation of upcoming rate cuts. There's a lot of difference of opinion of how significant it's going to be, how much cutting is going to happen, whether that cutting is going to be associated with a recession or not. And I think those are all valid questions. But I do also think that again, it's a different environment than any of these particular environments because the interest rate component, the main driver that has on the economy is it impacts credit creation, right? When mortgages are 8%, no one can afford a mortgage. When they go back down to 4%, people can afford them. Same thing with business loans and all that. Um, but a lot of people have locked in low fixed rate mortgages. A lot of investment grade corporations have locked in very low 10, 20-year debt. And so a lot of this is affecting around the margin loans. It's affecting junk bonds. It's affecting small businesses. It's affecting people that haven't locked in mortgages on property and are looking to buy, or those that are looking to move, right? So there are impacts to it. But again, when this eases, we're only really easing, this component. So we could get like a bottoming of, private sector credit creation, and you can actually get a little bit of a rollover in the fiscal deficit because you might ease interest expense a little bit, or at least you might not, it might go up at a slower rate. Um, and so it's a different environment. So when it comes to investment implications, there's a few ones that I focus on. One is um, think about like companies operating in sectors that have already gone through what is effectively a recession for their industry, right? So anything that was impacted by this credit tightness, right? Or anything that was impacted by very high rates, right? So if you think of a company like Alphabet, Google, right? Were they impacted by these high rates? Well, if anything, the impact was positive because they have tens of billions of dollars of cash equivalents. A lot of it's in T-bills and things like that. And they have very low fixed rate debt. That's not that much. And so the more you raise interest rates, the more you give Google a raise. They just get more interest income, and their interest expense is small and locked in. On the other hand, if you're a commercial real estate operator and you have a lot of debt and you have to roll that debt because it's generally shorter duration, lower quality type of borrowings, you're heavily impacted. Now, commercial real estate is not synonymous with office real estate. I mean, that's obviously been the hardest hit part because there's multiple things there, but just commercial real estate in general has had a rough time because it's a more asset heavy and leverage heavy type of industry. And so that has effectively gone through a recession. Whereas other areas have not. The travel industry is not, at least not since, not in the past few years. The tech industry is the profitable tech industry, the mega caps. I mean, they've been fairly unimpacted by this recent environment. And so when we look forward to what is interesting for the next couple years, I think it's useful to look at companies that are actually, what generally does well coming out of a recession, because in some ways, at least some parts of the economy, that's what seems to be happening. Um, and when you look at the companies that are fairly recession proof or that weren't affected by this environment, they're generally quite expensive. One of the examples I like to use is Costco. It's an amazing company. It's one of the few companies you can picture that's liked by shareholders, employees, and customers. Usually business only gets like two or three of those. I mean, two out of three of those at best. Whereas Costco is kind of everyone likes Costco. And the problem is that Costco is trading at 55 times earnings. Investors are very willing to pay up for um, low fundamental volatility, low uncertainty, low recession risk. Whereas there's many more cyclical businesses that are trading at 8, 10, 12 times earnings. very profitable, paying dividends, buying back shares, strong balance sheets. Um, because so many investors, I think, are concerned about the upcoming recession. And I think there is risks there. We do see unemployment rising from a low base, which is historically a recession indicator. Um, but again, this was a more unique environment. And so I do think that there are opportunities to look into places that have already effectively gone through a recession, and that therefore they're generally cheap. They're already kind of beaten down, and so a lot of that's already priced in compared to the very expensive sectors. So I'm happy to take questions. We can go over this. We can go over investment ideas, and thanks everyone.
Hi, we have a question. Could you comment on the idea of a rolling recession versus an all-at-once recession, like the last three? That sounds like what you're describing.
Yeah, that's a great question. That's generally how I view it. Um, that we have industries going through recession at a time. Now, the one of the closest periods to that would be like this 2015, 2016 period. We had in many cases what could be considered a recession for certain industries. So purchasing managers index for manufacturers rolled over, for example. The oil and gas sector was very impaired. Emerging markets went through a big turmoil in this period here. And so that was one that was a industry specific recession that was not broad and impactful enough to impair the broader economy. So far, we've kind of had a similar thing here, but at a bigger magnitude, which is that a number of industries have gone through what is effectively a localized recession. So, commercial real estate, manufacturing, um, businesses in those areas have struggled. Small businesses have been pressured. If you look at stock indices for small caps or even mid caps, for example, they're not this like big vertical upward chart that you see with most of the Mag 7. Um, and so I do think that that's effectively what we're going through, and that as some other, as certain industries emerge from what has been a recession, other ones start to weaken. So we might see, we're seeing more weakness in consumer. Maybe travel and leisure is not going to do as well for the next 2 years as it has done for the past 2 years. You can get a reversal of roles. You can also get geographical rolling. So, for example, if the U.S. cuts interest rates, it might not be particularly stimulative for the domestic economy because, like I said, we've already locked in a lot of fixed rate debt. Whereas emerging markets might be the ones to benefit because they've got dollar denominated debt. The Fed's going to go through a cutting cycle, which is generally easing for the dollar and takes some pressure off of those emerging markets. And a lot of them, I think, are like coiled springs. So I do think that you can have surprising periods of strength mixed with surprising periods of weakness. Um, Generally, what makes a economy a wide recession is that unemployment cycle, because that's kind of the one that feeds on itself. As more people get laid off, they consume less, which then impairs businesses, and then therefore they lay more people off, and therefore they consume less, and you get this kind of vicious cycle. So that's why some recessions become big enough to be considered a broad-based recession. And it's still possible. I'm not discounting the risk for that. I would suspect that if we do get a pretty sustained unemployment increase, it'd probably look more like the post-dot-com recession, which by most indicators was not as severe as many recessions around it. Um, Obviously the equity market started very high valuation, so it was impaired, and that was not in fiscal dominance. But it's not, not every recession is one of these massive events that we've become accustomed to in the last 15 years. Recessions can take multiple forms. And so I do think that rolling recession is probably the right lens to view it. And if you get enough rolling recessions, then yes, you can have a broad-based recession.
Great. We have two other questions. What do you think about the energy markets now? Oil and gas question mark.
It's a good question. I'm long-term bullish. The way I've been playing it is I like the producers more than the underlying commodities themselves because the producers are in many cases profitable at current prices. They pay good dividends and buy back shares. They've held up better, than oil itself over the past couple years. Um, I think the biggest variable to watch here is China. I think in this case, there's too much emphasis on the Fed. There's too much focus on the United States, whereas China is a more physical economy. They're when their economy's booming, they're building more. They consume much lower per capita oil than the United States does. And, right now they're in an economic malaise. Their property sector has been disinflating, and China, they've been more reticent to stimulate fiscally because one of their other main objectives, is that they want to internationalize their bond market and their currency market. What I mean by that is when they want to be able to reduce their need for the dollar, and they want to be able to pay their trading partners with their own currency more and more. And they're gradually doing that, but it's a stepwise process. And right now, China is the biggest trading partner for most countries in the world, right? So when you look at trade as a percentage of GDP, most countries, when they answer that question, who's our biggest trading partner? It's China. Something like 80% of countries. Much smaller minority, it's the United States. That's switched over the past 20 years. And so both domestic consumption for China of oil and gas, as well as their downstream impacts to all the economies that they touch. Um, I think that's the biggest variable to watch for oil and gas because when they decide to stimulate more aggressively, when they decide that the pain of deleveraging and slowdown is getting too much, they can turn on a dime. The most recent example was they had years of zero COVID policy, but eventually the world was kind of moving on, and they were still stuck in lockdowns. And then there's pretty widespread protests in China, which are pretty rare. And the administration there kind of flipped on a dime and just went back to opening, just because the from their centralized, CCP perspective, the cost benefit analysis was no longer favorable for keeping that. We are starting to see more and more sentiment online in China that is unhappy with the state of the economy. And should that, keep going and accelerate, it increases the odds that they'll eventually want to stimulate out of this deleveraging cycle that they're in. And I think that's probably where we have the next energy bull cycle. It'd be hard to get much, short from a acute supply disruption. It'd be hard to really get a big boost without China participating in some meaningful way.
Okay, great. We are starting to get more questions. So, how soon after the Fed begins lowering rates does it take before employment improves?
Well, I don't necessarily think that that's going to be much of a correlation. Unemployment's already historically good. Now, there's different ways to measure. We have a little bit lower labor participation because more people have retired, and the one pocket of unemployment that's pretty bad is young men. That's been more of a structural issue than something this cycle that's been rising for the past couple decades. So there are pockets of problems. Um, but I don't, right now the unemployment rate is roughly where the Fed projected that they wanted it to be. They've said that they don't really want it to get softer. Um, Instead, I view, the interest rates as impacting the areas that have been hurt by high interest rates. So things like, commercial real estate that's viable, right? So I mean, if you're an office building in a city that is overbuilt in supply, then interest rates aren't really going to help you. But if you are running what is otherwise a in-demand property, and you're just squeezed by high interest rates, then these lower interest rates can start impacting. And I would say that's already happened. I mean, long rates, as we see here, have front run the Fed, right? So these are 2-year yields that have front run the Fed. But if you look at 10-year yields, they've done the same thing. They've all front run the Fed, and we're seeing that in other parts of the lending market as well. And so, for example, you see some REITs that are off their bottoms. So a lot of REITs bottomed in 2002, 2003, kind of during this peak of pressure. And as we get these cuts, we start to get a little bit signs of life from beaten down sectors. So I would say that that's already impacting, um, and I would expect that to probably continue for in the year ahead.
We have 1 more minute, so let me ask one more question. Your comments on China, is there a risk of the dollar no longer being the reserve currency, and that would be the impact of that? And what would the impact of that be?
I mean, I think that's a 2030s question, not a 2020s question. These are very big network effects that take a long time to change. I would say that there's no currency in the world big enough to be the only global reserve currency anymore. I think instead what we're seeing a broadening out, right? So the United States after World War II and in the past, this whole period has been unusual. There was basically the rest of the world was destroyed. The United States was left standing. They were over 40% of GDP. And over time, as we've seen the world recover, and then we've seen China emerge in the 80s, 90s, 2000s, 2010s, as we've seen the rise of the BRICS global. So I think that the dollar is probably going to gradually diminish as a share of reserves, as a share of international contracts, but that it's still going to be one of the two biggest, probably the single biggest for quite a while. So I do think those effects matter. I think they're beneficial for gold. For some countries, they could be beneficial for Bitcoin. I mean, there's a handful of countries like El Salvador or Kingdom of Bhutan that are holding Bitcoin, but for most of them, it's gold currently. It should be, it has impacts on the market, but it's not this Boolean question of, tomorrow or next year or the year after, is the dollar not going to be global reserve currency in the world anymore? That's a long-term transition that takes time.
Great. All right, everybody. That concludes our time for this session. Thank you all again for joining us, and thank you, Lynn, for your presentation. Please be sure to stay tuned as we have more in store for you this week.